In 1907, the United States banking system stood on the precipice of disaster. It needed help and it needed leadership. Luckily, it had John Pierpont Morgan. I learned about J.P. Morgan and the Panic of 1907. So I'm back with another financial crisis, another panic. I told you there were a lot of them. Wonder when I'll get to Panic at the Disco. The Panic of 1907 is unique because it is credited as being the impetus for the Federal Reserve. Now, the Federal Reserve didn't come into effect until 1913, and this is 1907. I don't need to do the math for anyone, but obviously there's some time between. Okay, 6 years in case you thought I couldn't do basic math. Fine. However, most historians do credit the 1907 panic as the reason there's a Federal Reserve. So that's what makes it special, unique, important, historical. Before we continue, let me explain what the Federal Reserve does. This won't be a complete in-depth rundown of the Federal Reserve's duties. I'm just giving a basic idea of what the Federal Reserve does, and then I'm going to very cleverly tie it together with the Panic of 1907. Maybe it won't be that clever. Probably not. Oh, also, I will likely call it the Fed since that is its commonly used nickname, and we're friends like that. The whole thought behind the Federal Reserve is that banks often need excess cash reserves to get through periods in which their numbers are light. I know that seems counterintuitive to some people that a bank that has all your deposits needs cash, but it does. A bank takes your deposit and then, in theory, lends that out at a rate higher than they pay you, if they pay you at all. That's how a bank makes money. It's the difference between what it pays you to hold the deposit and the rate at which it lends it. It makes money ignoring fees, but we'll ignore that. You may already be spotting the issue here. What happens if there's a run on deposits? What happens if suddenly a lot of customers want their money? Like the commercial says, it's my money and I want it now. I could be an actor, guys. Banks don't have that cash on hand. They've lent it out. We haven't even discussed how banks leverage their capital and deposits, and we won't. That's way too in depth. But let's just say it makes it so banks have even less cash on hand than you think. They have enough for the occasional person to come in and want their deposits. One customer coming in wanting their money, no problem. What they can't afford is when a lot of customers come in trying to get their deposits. They don't have that cash waiting. Also, just as a quick clarification, when I say cash on hand, I'm just describing the cash a bank has in its own accounts, not physical cash at a bank. Like, this isn't Ocean's 11 with every bank having a huge overflowing vault, though that would be kind of cool. There's the famous scene in It's a Wonderful Life where George Bailey explains this exact situation. And I'm going to do this impersonation, so deal with it. Your money is not here. It's in George House, in Kennedy House, in 100 houses. So that impression is terrible, right? Anyway, that's what happens. They lend the money elsewhere. What the Federal Reserve does, besides acting as a regulator, is provide a space for banks to get the cash they need. First, they have a window where banks can borrow from other banks with excess reserves. Some banks have them. The Fed sets the rate at which banks can borrow. This is the rate that makes all the news. They also act as a lender of last resort, where a bank can borrow directly from the Fed in case it needs it to fulfill its needs. If the other banks aren't lending. If you're wondering then why the Fed rate is so important, it's because banks use the Fed rate as a determinant on their own rates. They're going to make sure they are getting more in their loans than they are paying for the Fed for their borrowings. Makes sense. I apologize if you didn't care about any of this, but I thought someone may need to know, and it is important to understand what the Fed does to understand why the Panic of 1907 helped lead to its creation. Have to understand one to understand the other type deal. Also, it's still relevant because we still have bank runs. What was it, a summer, 2 summers, 3 summers ago, where we had all those bank runs for Silicon Valley Bank? So people still freak out and go to the bank, especially if you're over the FDIC insurance coverage limits. And we're not getting into the FDIC. That doesn't come into effect until 1933. Okay, so that's what the Federal Reserve does. I pointed out that it didn't exist in 1907, didn't start existing until 1913. So what happened in 1907? How did banks handle large runs on their deposits? Well, some banks had clearinghouses. Essentially, clearinghouses operated in place of the Fed. They would issue loans to banks who needed cash. However, these clearinghouses were privately owned. There were just a bunch of banks that got together because they saw a need. They formed a group and agreed to help each other out. There's a problem with that. It gave them the freedom to do what they want, to say yes and no based on their own whims. So, for example, let's say it's October of 1907. Oh, wait, that's what we're talking about. That's neat. Look what I did. Anyway, a gentleman named Charles T. Barney of the Knickerbocker Trust Company gets himself into some trouble due to a stock market manipulation scheme. When the scheme came out in the news, people were concerned. When several banks failed as a result of the scheme, even more people are concerned. All this concern led to one thing: bank runs. Financial panic often spreads like a disease. People hear things and they spread their fear to others, and so on and so forth. Which meant that when people realized Charles Barney was involved in a scheme that just brought down other banks, they flocked to get their deposits from his bank. Quick side note: technically, Knickerbocker Trust was a trust, not a bank, but they operated pretty much the same way. They were just far less regulated. That's always a good thing. What was Knickerbocker Trust to do? They went to their clearinghouse, but clearinghouses did not have to lend the money to the bank. They were private. They could make their own choices. So they said no. Maybe they're Celtics or Sixers fans. Let's go for the Sixers. They're just not interested in helping the Knicks out. Included in the decision that not to lend them the money was JP Morgan. So remember that when we talk about what he does to help things out. He played a role early on and it made things worse. Because it did not end with the Knickerbocker Trust. No. Soon after, Trust of America and Lincoln Trust also saw themselves get caught into these crosshairs of the public panic. If these two trusts went down, others would absolutely follow. It's how it works. JP Morgan, understanding the problem he was facing, decided he had to intervene. Morgan intervening was a big deal because Morgan was a big deal. He was the most powerful banker in America, probably even the world, at the time. In 1901, McClure's magazine credited Morgan for shifting banking power from London to New York. In case you're curious, I talked about him in my Jay Cook episode. He is a legend, a truly foundational piece of American banking. Morgan, working with his fellow bankers, managed to get funds into the Trust Company of America, allowing it to stay open. Further strengthening his efforts was a $10 million deposit by John D. Rockefeller into the trust. Friends in high places really helps. Though I guess Morgan was also in a high place. Is it friends in your own place? Why am I even asking this? Bankers were determined to keep making things difficult. The banker who typically made short-term loans to the stock exchange to facilitate stock purchases decided now would be a good time to not do that. This could have crippled the New York Stock Exchange. The fallout from that is hard to fathom. So Morgan got his banking buddies together again. Somehow, over the course of the next 2 days, they managed to get enough funds available to stabilize the stock exchange. It still went down, but it was stable. Oh, but hey, to make things worse, New York City was about to run out of cash and needed close to $30 million to stay liquid. So Morgan, on behalf of his bank, along with two other bankers, pledged to buy $30 million of bonds from the city. Thus, Morgan bailed the city out of a jam. Always need a friend to bail you out of a jam. J.P. Morgan had used his clout to help stabilize trust, the stock market, and New York City. Should have been easy street from then on out, right? Well, no. A brokerage firm called Moore and Schley was finding itself in a bit of trouble. So much so that it looked like it was going to fail. They had borrowed a lot of money using the stock of the Tennessee Coal, Iron, and Railroad Company as collateral. But now the market was questioning the value of the stock, and it looked like all their loans were going to be called. Calling a loan is when you are required to be paid in full. This call would have forced the stock to plummet, which means Moore and Schley would fail. We just discussed how financial panics are like a disease that spreads. Morgan understood this and worried that if Moore and Schley failed, others could follow. So he called a meeting at his personal library to solve the situation. Well, actually, he called a meeting at his personal library to solve two situations. The other situation involved trust companies. You know, the things that got us started. Morgan wasn't satisfied that the Trust Company of America and Lincoln Trust could survive. They needed bankers to lend money to help them out. Morgan viewed this as a priority. In fact, he wouldn't save Moore and Schley without the trust company situation being solved, which I kind of understand. If the trust failed, then saving Moore and Schley was a moot point. The market was going to crash either way. The bankers Morgan brought in weren't exactly willing. There was, let's just say, a lot of debate. To be fair, the bankers were probably cranky. A lot of this was happening overnight at like 3 a.m. Probably wanted to get out of there, but not so fast. Morgan locked the door. They were stuck. Honestly, to me, that seems like a scene out of a sitcom where the dad locks his two kids in a room till they can get along, big family hug. Several hours later, Morgan finally managed to convince his fellow bankers that saving the two trust companies would help save the general banking industry. They agreed on a loan of $25 million to be made available to the two trusts. So they did their hug, I guess. One issue down. Morgan did have an idea on how to save more in Schley. He decided U.S. Steel should buy TCI. This would strengthen the collateral of all loans made on TCI stock. It would also likely prevent banks from calling those loans since they felt confident now. It wasn't an instant hit of an idea. U.S. Steel was hesitant, but JP Morgan had a good relationship with them and eventually sold them on the idea. However, Morgan also had to convince President Theodore Roosevelt to approve the deal. Why? Because it looked an awful lot like a monopoly type situation, and Roosevelt was not a fan of monopoly. He preferred Clue. It should speak to how dire people felt the situation was that Roosevelt approved the purchase quickly. In less panic times, he may have fought against it, but he knew things had to happen, so he agreed. If you're sitting there and you're wondering if historians have overplayed the hand on JP Morgan's importance, I would point out that the United States Secretary of Treasury, George Cortelyou, gave Morgan $25 million in government funds to use as he saw fit in this period. Also, the Boston Stock Exchange thanked JP Morgan for his help. At the time, people recognized how important Morgan was and what he was doing. Looking at this whole topic, I realized one very obvious fact. Morgan isn't a dumb man. You don't get to be where he's at by being a dumb man. He realized that if the banking industry collapses, he's going to suffer. He's not nearly shielded enough to not feel the consequences of what's going on. While I believe Morgan did care about the American economy because he was American, I also realized he has a selfish motive. Helping the banking industry helps himself. Fairly simple equation. But let's get to the issue of what happens if there is no JP Morgan. That thought had to cross the mind of everyone involved. What if there's another panic, but now there isn't someone strong enough to bully everyone to helping out? What if someone doesn't have the key to the lock? What if we can't lock bankers in a room? What will happen to the banking industry? What will happen to the American economy? Clearinghouses showed their flaws. They're private. They're not compelled to do anything. They could let banks and trusts fail, and they would not have to violate any laws. Now you can see why the idea of the Fed started gaining traction after 1907. It had been discussed and thought of previously, but an event was needed to help propel it forward. Even with the panic, it took 6 more years to be passed. Remember I did the math for you guys? Morgan had something to do with that as well. I mean, there's a whole story of him helping get the Fed built, but that's another story for another time. Though equally fascinating, and I may cover it. I found learning about the panic of 1907 fascinating. It was quick, about 1 month, and it didn't lead to a depression or a recession. However, it had such a big impact on American history because it helped lead to the creation of the Fed. Like I just said, I know there's a lot more behind the creation of the Fed. There's a whole story that I may cover at one point. But the 1907 panic was central in those conversations. And I love the role that 1 month plays in history. Also, learning about JP Morgan has proven to be fascinating. In the late 19th and early 20th century, he was such a vital American figure. It always interests me when one person was such a dominant figure in American history, especially when they're not a politician or a general, he's a businessman. And regardless of how you feel about his business activities, he still was a huge figure in American history. So with that, I'm wrapping up my short, quick story on the JP Morgan and the Panic of 1907. This is a quicker one. It's a quick tale. Again, the event itself only lasted a month, so without going really in the weeds, I didn't have a lot to cover. Please like, subscribe, do all that fun stuff, and I'll have more of these. And like I said, maybe I'll cover the Fed down at some point. Thanks again.